I think the quarter was good, but I think it was a move of fundamentally 3 consecutive quarters of beats all year long. The stock really didn't perform well. It actually went down on 3 consecutive beats. The global comp was better this quarter. Global comp has been good all year long. I think it was mostly this quarter we had more beats, continued beats, and the U.S. comp was essentially in line. First 2 quarters of the year, the U.S. comp was a little bit weaker. So I think that's what's driving the rally now.
In terms of the investment, I mean, that was a major piece of the puzzle in terms of the earnings. Heavy investment in the experience of the future, particularly in the U.S., in an environment in which there are question marks surrounding the growth of the U.S. economy. Is that the kind of commitment that you want to see McDonald's make?
Absolutely. I think they have to invest in this experience of the future. It is a digital investment. It is an investment to upgrade the restaurants. Keep in mind that labor costs are rising. This investment will eventually allow them to remove some of the front of the house labor, some of that order taking labor at the front of the house. That will slowly go away as they make more in these investments. And labor costs are rising. It's really tight labor environment. You can't even find employees to run these restaurants right now. So I think they're getting ahead of the curve on tech and digital. I think it's a necessary evil for them to make this investment now.
So have they got pricing power?
I don't think anybody has real pricing power. That's the unfortunate part.
But they've raised prices, right?
Well, I think
a little bit.
You're getting 2 percentage points of price, which is in line with the industry, but generally speaking, taking much more than 2.5%.
Because that's a price-sensitive buyer there.
Absolutely.
And when they have gotten away from sort of the dollar values and the $3 values, they've run into trouble, right?
Well, what's interesting about that, though, is they mentioned this idea that the dollar menus, the value menus, have gotten them in the door, and then people have chosen to buy more and upsold food, so their average ticket price is going higher. So is that a good thing?
It's a great thing. I think it's the way that you want to bring them into the door, then raise the average check. But you can't take too much price, honestly. Like 2%, 2.5%, it's about as much as you can take. When you're seeing labor inflation of 3, 4, 5%, commodity inflation of 2 or 3%, your margins are under pressure. So you got to find a way to reduce the labor hours because you can't really do much about commodities.
In the meantime, before they're able to take labor costs out of the equation through this investment in digital, how much time do they have? And I'm asking because if you believe that the economy is going to slow next year, how sensitive is McDonald's to that slowdown? And how vulnerable are they to both the squeeze from the investment costs and also the labor costs?
So I guess you have to believe that we're going to slow next year, when we're already talking about wage inflation for this low-end consumer of 4%, maybe higher, and franchisees complaining that they can't even find enough labor, and they're having to raise wages and benefits to keep the employees at the restaurants. I'm not sure that I'm convinced that there's going to be a slowdown.